Okay, guys, it is that time of the year. It is end of financial year, and this is my favorite time where we go into finish off the year and go into the crazy tax season where I get to catch up with all our wonderful clients, which is fantastic. So what I want to do is I want to run through some critical things that may need to be actioned ASAP before the end of financial year. It's really important that you go through this, as there might be things that you may be able to do to significantly save on tax. And if they're not actioned before the end of financial year, you might miss out on those opportunities. So I have provided the guide to you as well, so you can certainly have a look at the PDF copy and utilize that as a checklist. But I've also just created this video as well so we can discuss and explore, just in case you're not quite understanding some of the things that are outlined within this guide. All right, so let's just cover off on a bit of an intro here. So, why is it important that we save on tax? Well, tax, when you think about it, a lot of people pay at least 30% of their income. So 30% of the income goes towards paying tax. So just imagine, this is what I tell my husband all the time when he doesn't keep his receipts. If you were to buy, let's say, a computer for $3,000 and you forgot to keep the receipt, and yet you could, if you had kept that receipt, claim 30% back. So it's $1,000 off that computer potentially that you could be claiming back. That's a massive discount. And if you think about all those things that you could potentially be claiming on, it definitely adds up over time. And when it comes time for you to retire, it could be the difference of tens and thousands of dollars, depending on your income earnings and your other deductions. So the things that you can do if you could save on tax: you could reduce your home loan, pay off your home loan sooner. You can increase your retirement savings, so top up on your super, have a holiday. Wouldn't that be lovely? I know I've got so many clients who love coming to see me each year because that's their holiday funds when they get their tax back. Deposit for an investment property, very exciting, and upgrading your car. I just mentioned it in another video I've just recorded, but I've just upgraded my car, and that's helped me to significantly save on my tax, which is the most exciting thing for me. I think my husband was excited for other reasons, but I was excited about the tax deduction. Nerd alert. Okay, so let's just run through some key things here. So let's get started in terms of talking about what are the key things that you could potentially do to save on tax before the end of this financial year. So super contributions. A lot of activities happening with super at the moment. A lot of people have, drawn down on their super fund, and they've either looked at putting it into the home loan, or they've utilised it to reduce debt. Some people have spent it on luxury items, and otherwise some of us have pulled it out thinking that we may need it, and now they've got the surplus funds that they're considering maybe putting back into superannuation. Okay, so while you might not be flush with cash right now and not able to put in large amounts into your superannuation, it's certainly important to be aware of your super, especially even if you're still young. You think, oh, who cares? It's so far in the future. But those incremental contributions, additional contributions to your super, can really make a difference come retirement. And the key thing to note here as well is it significantly can help you to reduce your tax. So income earnings within superannuation is taxed at 15%, whereas depending on how much you're earning, you could be taxed almost at 50% if you're an individual, high income individual. So big opportunities there to reduce your tax and increase your overall wealth through into retirement, beyond retirement. So other things to think about there is, with regards to that super, is the cap is generally up to $25,000. However, they are allowing for this carry forward contribution. So this is something new to this year, where they're allowing for some of the funds from previous years to be carried forward. So let's say, for instance, that this year, for whatever reason, you're able to put extra money into super and you want to exceed that $25,000, there could be an opportunity for you to do that. So if you want more information or you're not quite sure what that means, of course, there's more information in this guide, but feel free to flick me through an email and I can send you the necessary information and links to provide further information about that. So that's a really big one this year, and something that, again, has only come into play this financial year, and some pretty exciting stuff there. Other things that people often forget about is spouse super contribution. So if you've got a spouse who's not really earning much of an income and you're wanting to boost the super savings as well as save on tax, then there's an opportunity for you to get a tax offset of up to $540 on super contributions of up to $3,000 that you make on behalf of your spouse. So your spouse's income needs to be $37,000 or less. Okay, so if they're a low income tax earner, there's an opportunity for you to get money back there, which is pretty exciting. And those income limits are slowly increasing and whatnot. So it's important to keep a track of those as they do change each year. Okay, so additional tax on super contributions by high income earners. So if you are a high income earner and earning more than $250,000 a year, you could be up for additional tax. So that's something to just be mindful about. So have a bit of a read on that. If you're not sure about Div 293, these are the fancy terms that us accountants give it. If you're not sure about Div 293, again, flick us through an email. I'm more than happy to go through those in more detail with you. Government co-contribution. So this is another way for you to boost your super and get some additional funds back. So in 2020, the maximum co-contribution available is if you contribute $1,000 and earn less than $38,000, then you can get up to $500 back. So that's 50% return on your funds. That's, I don't know about you, but there's not many places that you can go to reliably get 50% without putting it all on black, so to speak. So a really good opportunity. And again, if you're a low income earner, by putting that $1,000 in, which is really just $20 a week, then you can get that extra money in your super. And I've got clients that do that year in, year out, and it really does make a difference to their overall accumulation. Okay, next one. So ownership of investments. Here we just talk about if we've got clients who have properties and they're looking at capital gains, that the consideration of utilizing a family trust structure to help to distribute their income to some of their children or even grandchildren, just to minimize that. It's not as high as it used to be in previous years. It's now reduced down to $416. But if you've got 3 children to distribute to, that could be a savings of still about $400. So it all makes a difference at the end of the day, and some opportunities there depending on your circumstance. So if you believe that could be you, again, reach out to us and I can talk to you about that in a bit more detail and send you through some additional information. Property depreciation report. Make sure if you've got a property that you have had a depreciation report prepared. It just helps us to calculate your capital works, deductions and capital items that we can depreciate. So it's all about depreciation. The great thing about depreciation is it doesn't reduce your cash flow, but it can help to reduce your taxable income. So and then ultimately resulting in a higher tax refund. Okay, so if you've got a motor vehicle and you, if you want to maximize your deductions, I know I've had a chat with many clients over the years, and every year they come in and I say, yes, you know, you should have done the logbook, and they go, yes, Jackie, you've been reminding us for many years, and I highlight that we could potentially getting back an extra $1,000 or $2,000 if they do so. If that is you, here's my prompt yet again. Make sure that you have your vehicle logbook completed, especially for those who are doing substantial kilometres for work. Really important. So some information there. Again, if you are doing less than or wanting to claim up to 5,000 business kilometres, we can certainly use the cents per kilometre method. As long as we can reasonably substantiate that mileage, then we can certainly go about doing that. Other things, salary sacrificing into super. It's probably a bit late now to have a look at that as we're at the end of the year. But if you're not sure about salary sacrificing, maybe have a chat to me when we're finalising your tax return, and we can talk about those options that you can potentially discuss with your employer. Prepaid expenses and interest. If you've got an investment property, you can always look to potentially prepay interest, or if you've got some other investment loan structure put in place. Other things that you can look at is repairs on your property, membership subscriptions. You can even prepay your accounting fees if you're wanting to do that. I know that we've got some clients who do choose to do that. Good for you, not so good for us because it increases our income and means more tax for us to pay, but certainly helps our clients. Insurance premium. So if you have income protection and you're either paying monthly or it's not yet due, you can actually prepay 12 months in advance to accelerate that tax deduction and bring it forward into this current financial year. You might have other insurance premiums that you're paying monthly and again can choose to pay in advance. So if you've got considerable tax to pay, now's the time to be assessing some of those options. Of course, the biggest thing with some of these prepayments and expenses is that you've got to have the cash flow to be able to do it. So you need to assess whether or not it's within your budget or within your cash flow for you to be able to do that. But if so, certainly have a look at those options. Work-related expenses. This is a big one. Please don't forget your receipts. Start getting your receipts together. Start thinking about the things that you can and can't claim. The things that we might forget about. I know we've got a lot of teacher clients often didn't even know that they could claim working from home or certain resources that they use for their children and for their teaching. So if you're not sure, reach out. And we've got various fact sheets for various industries and occupations that we can provide to you as a bit of a guide. As you book in to do your tax return, we'll be prompting you on various things anyway to ensure that we maximize your tax return. So start thinking about the expenses that you have throughout the year. I know even when I do my own tax return, I have issues of remembering the things that I've spent throughout the year, and so I like to just try and keep a folder where I automatically save it down because I don't know about you guys, but I think I'm going to remember, but life's just so crazy these days that it's very easy to forget all these various courses and other expenses that we've incurred. Realized capital losses. So if you've got capital losses sitting there, it might be an opportunity to recognize some gains where you don't need to be incurring any capital gains tax if you've got those losses sitting there. So just review your capital loss position. Now might be the time to utilize those. If you're not sure, again, happy to discuss. Defer investment income and capital gains. I talk about this in the other business video that I've also created as well. But the key thing to note there is if you've got an investment property or if you're transacting in a purchase or a sale, the actual settlement date is not the date of sale isn't actually the settlement date, it's actually the contract date. So if you are selling something and thinking that if you date it in the next financial year, the settlement in the next financial year that you covered, that may not be the case. It goes off the contract date. So check in if that could be you and something to think about. Another thing to think about, if you've got substantial funds within your super, if you and your spouse could potentially combine your super and have in excess of $500,000, then this could be an option for you. Certainly there are cost savings in terms of managing a super fund. And there's also, huge benefits in terms of being in control of how your funds are invested as well. So again, the combined amount is $500,000. So if you think that's you, then again, reach out to us and we can discuss those options. I think that's it, guys. So just some of the key things that are often overlooked or people forget about, critical things that need to be addressed in action now. If you have any questions, concerns or queries or need further information, send me through an email and I'll get back to you on those ones. Otherwise, we're really looking forward to catching up with everyone, and we've got a new system in place. So looking forward to rolling that out with everyone and introducing some of the changes we've made to make it easier for you to process your tax. So I look forward to talking to everyone very soon. Thanks, guys.